I'm joined by Gautam Duggad, Head of Research at Motilal Oswal Institutional Equities. Gautam, thank you so much for taking time out and joining us.
Thanks, Pallavi.
You've spoken about quite a few sectors that you're bullish on, over the next few years. What are your picks and why so?
Yeah, hi. If the outcome tomorrow is not too different from what the exit polls are predicting, then we expect policy continuity, policy momentum, and stability to maintain. And themes which have worked in the recent past, we expect them to continue to do well. So PSU banks, energy, power, capital goods, real estate, automobiles. These are some of the sectors where we have a bias and a overweight in our model portfolio. And we think that sectors like PSU banks and real estate, which are cyclicals, and still have some, especially in case of PSU banks, where the room for valuation upside is still there, they can continue to do well because now you have 5 more years of policy visibility, and that augurs quite well for capex oriented sectors, manufacturing oriented sectors, something which we've already seen working quite well in the last 12, 18 months. We expect that continuity to also reflect in the wealth creation.
Got it, Gautam. Harsh also joining in. I want your quick take with regard to energy, especially because you've spoken about that. We've seen how energy stocks have really rallied over the last 5 years. In fact, one of the top sectoral gainers in Modi 2.0 era. You expect that to continue into Modi 3.0. Talk us through the factors. Of course, possibly one of them just being the energy deficits that we've seen. But outside of that, talk us through what those positives could be and how valuations therefore are looking that's making you so bullish.
So we like OMCs, within which HPCL is part of our model portfolio. We think crude is in a nice range. Valuations are still cheap, and there is a decent dividend yield too. So that is one space. Second, we like ONGC too, given the dividend yield and valuations. GAIL has been part of our top 2024 ideas, and also something which we like, given where the underlying businesses are, operating, specifically petrochemicals, where we expect a turnaround, transmission, where we expect a good 7-8% volume growth. So we're expecting ROEs and free cash flows to also improve for GAIL. So that is one name which we've been very sort of bullish about. And then, of course, there are names like Coal India, which incidentally, again, is part of our top 10 CY24 ideas list, which has done well. Results were good. We have seen earnings upgrade, and dividend yield also remains pretty strong. So some of this, PSU names belonging to energy basket have been part of our preferred bucket list.
And Gautam, if I can switch focus more towards the railway side, but stick to possibly that theme which has done well in Modi 2.0. Within railways and aviation, you also seem to have a hint of flavor of Indigo. You like Interglobe Aviation. Now, aviation itself globally per se has never done well as a long-term theme. What makes you so bullish on Indian aviation? That's one. And second, on railways, again, we've seen a very good rally. You still see value there?
So railways, I won't be able to comment because we don't track individual railway stocks.
Sure.
But as a theme, it might continue to do well. And valuations, while they look expensive, they can remain expensive or get even more expensive before they correct. So very tough to take a call on near-term valuations for some of these themes which already run up well. As far as aviation is concerned, I think there is a clear consolidation to happen. You have Indigo with a clear lead in terms of market share, more than 60%. But I think Power which has also come back a little bit, given the number of people that we've seen traveling has crossed the pre-COVID level, the monthly data which comes out. And plus ATF prices being down, the new capex which is happening, it does provide a good long-term visibility. Yes, I do agree with your point that globally not many aviation companies have made money, but wherever they've made money, they've created tremendous wealth. And one of the important aspects is the leadership position, whether you have a leadership position or not in that market. If you do, then obviously you create a disproportionate competitive advantage for yourself. And that is what we are seeing playing out in Indigo.
All right. Gautam, you have also spoken about being positive on domestic manufacturing. We've, of course, seen the government's thrust on manufacturing. GDP figures came in on Friday. Manufacturing is performing fairly well. That's expected to be the case going forward, given government incentives. How are you viewing the sector, and any stock-specific picks there?
So, we like EMS companies. We have coverage on EMS, Aviation, Data Pattern Sign, some of those names. So clearly, they seem to be doing quite well. The results just got declared, the fourth quarter results, has done reasonably well. So that's a space we remain quite active on. And manufacturing encompasses many things. I mean, there's no particular sector which you classify as manufacturing. There's manufacturing inherent in many subsectors, right? And within that paradigm, we also like real estate. It's been one of our most preferred sector for more than 2 years now. We see that the cycle can elongate for a longer duration than what we are used to in the past. So we do have Godrej Property, Shobha in our model portfolio. We still think that there's enough steam left there. And in the same breath, if I may, I can also add things like hotels, and some of the consumer discretionary names where the going has been really good. Some of the cyclicals like auto or property or for that matter, even the other sectors that we just spoke about, there, what has actually transpired is that the conventional duration of the cycle is changing. For example, we are already in the third year of real estate cycle or third year of a hotel cycle. In the past, we have seen that cycles get over by 4 or 5 years. Possibility of those duration getting extended this time is pretty high. We must remember that hotel, for example, was in a down cycle for almost a decade. And now we are just in the third year of the upcycle. I agree, the stocks have already done well. But clearly, the demand-supply gap in terms of the CAGR that they have, the gap in that CAGR is pretty high still for some of this sector upturn to continue. And thus, our entire focus within our model portfolio is more on the domestic cyclical side. Right, we are underweight on defensives, whether it's consumer staples a little bit, or even IT for that matter, where we're still running an underweight position. So portfolio stance is very clear, and I think the continuation of this government, we will know by tomorrow whether the exit polls numbers are correct or not. But last two times, 2014, 2019, if you see, whatever eventual performance came, it was slightly better than what exit polls predicted. So if that were to happen tomorrow, you have a decent visibility and run up for growth and policy momentum to continue for the next 5 years. And that obviously lifts the valuations of a lot of sectors, because the near-term big events are never about 1 year forward Ps or 1 year valuations. They're always about big themes and big sort of wealth creation.
Right, Gautam. Gautam, what's your sense with regard to the Nifty valuation overall at the moment? We've seen a good rally in broader markets as well as now on the Nifty 50 itself. Do you believe that it's going to be some bit of consolidation before we see an up move now? Also, I want to try and squeeze in one more part of this question where I want to try and get your take on FIIs, because FIIs yet not big buyers in India. Of course, some bit of buying we've seen. What's your sense? You believe that they'll enter at this point and therefore there's more room for upside from here?
I don't think one needs to look at markets in that context, whether a particular set of buyers come in or go out and whether that drives the market up or down. I don't think that's a sustainable way of creating wealth in the long term. Look at the last 3-year data, CY 22, 23, and first 4 months of CY 24. The total cumulative FI flows are zero, and total domestic inflows are $72 billion. Right? Despite zero FI flows, we have seen enough returns in the market. Right? So therefore, to obsess about a particular band of investors, whether they will get in, what time they'll get in, and which stocks they'll buy, I think it doesn't matter in the long term. Secondly, to answer your question on Nifty valuations, they're trading at about 20 times right now, which is pretty much in line with the 10-year average, 1 year forward P. So valuations as far as Nifty is concerned is quite reasonable in my view. Yes, valuations are stretched in mid-cap indices, small-cap indices, but that's how it always is. Market never trades at average valuation. It either trades at a premium or a discount, right? So as far as large caps are concerned, clearly there is more value there when you compare them with the small and mid cap indices. But even within large cap indices, there are some sectors which are overpriced and some sectors where there is enough value that exists. So the index is always an interplay between various sectors with expensive and relatively more reasonable valuations. So I'm quite comfortable with Nifty valuations as of now. In fact, if our predicted EPS of 1140 and 1320 for FY25 and 26 doesn't see any cut in the next 6-9 months, then if the current valuations continue at 20 times, you have a reasonable chance of Nifty trading around 26,000 1 year down the line. If we were to discount FY26 EPS by 20 times 1 year later.
Right. Gautam, we've spoken enough positives. In fact, we've spoken a lot of positives. I want to try and throw you a question with regard to where you see caution. Where do you see the possibility of downside more than upside here? Is there a specific pocket, space, sector, company? What's your sense?
Yeah, so clearly consumption remains very weak still in the economy. Whether you listen to the corporate commentaries or also to the GDP data which got released last week, there is definitely an issue in the consumption side of the economy, where there is a problem as far as growth and volume growth are concerned. Other element, obviously, some of the overrated sectors, some of the spaces which are flying without cash flows, without concurrent earnings growth, they will definitely come under pressure at some point of time. Just that we don't know when, right? So valuations, obviously, one has to keep a very keen eye on, especially in mid and small cap. That's a big risk. And third, any upheaval globally, because this is a year full of elections. We are done with ours, but there are more than 20 elections lined up. So that can obviously create its own sort of volatility and geopolitical situation. So one has to be cognizant of that. So, but remember that market never corrects on known risk. Any big correction has always happened when unknown risks have transpired. So typically known risks are usually get discounted quite fast. So when markets do correct, we will not know why it is correcting. Those risks will unfold, only then.
Thank you so much for taking time for us, Gautam.